Hi there everybody and welcome back to another stock analysis video. In this episode, we are going to be doing the behemoth company that pretty much makes a ton of products that a bunch of people buy, and actually in some cases I didn't even know that I bought occasionally, and that is, really can't see it by this thing, but it is essentially Kimberly-Clark. Kimberly-Clark, guys, is one of those companies that absolutely sells everything. As you can see here, by the trusted brands, we got Viva, Scott, Huggies, Pull-Ups by Disney, I think it is. I don't necessarily know. Cottonelle, I don't even know what that is. Huggies again. We got Kleenex. They just pretty much sell all in all brands that have to do with like adult care, child care, family care, that kind of stuff. Starting off with this analysis, we got the dividend summary, and guys, Kimberly-Clark actually has a pretty decent dividend, and in fact, it's a pretty good dividend enough to be qualified as that for a dividend portfolio. So you can see right here, dividend yield of 3.19%, which comes out to be $1.14 a share for an annual payout, guys, of $4.56. Payout ratio in regards to the net income is 73.85%, which is very, very high. I like to buy anything between, well, actually no, rephrase that. This is in regard to the net income. I want to see how much this is in regard to the cash flow. I don't necessarily know, but just here from the net income, it is pretty high, and personally, I don't like to see this. The 5-year growth on this dividend has been around 4.38%, which is it's a little bit on the low side. However, it is still very, very good when you consider that they are almost a dividend king with a dividend growth of 49 consecutive years, which is just crazy to think about. Ex-dividend date was December 9th, so unfortunately it already passed, and we are going to actually get paid this tomorrow. I am recording this on the 3rd, so we're going to get this dividend paid out tomorrow, and they pay out their dividends quarterly. Now, coming over here to the calculator, we got the ticker symbol KMB, market cap, guys, of almost $48 billion, PE of 24.24, which is a little bit high. Obviously, I would like to buy anything under 20. 24.24 is a tiny bit high. Share price of $142.43, and as we saw, a dividend yield of $4.56 annual per share, which actually ends up being the amounts paid of around $1.5 billion paid every single year in their dividends, which after paying this, guys, they are left with a mere $612 million in regards to their free cash flow. This translates to a payout ratio in regards to this free cash flow of 71.5%, which is very, very close to the one to the net income. And again, I like to buy anything under 60 or less at least. And the fact that this is 71.5, guys, they are really, really cutting it close. I mean, they're left with $612 million. Now, obviously, that is not, they still have a lot of money left. However, in regards to other companies, this is really cutting it. Also, this doesn't really leave enough wiggle room for paying down debt, making acquisitions, etc. So definitely something to take a look at and to take into account when looking into this company, especially for a dividend portfolio. Now, coming over here to the fundamentals, we got the net income 5 years ago of $2.2 billion to 1 year ago of $2.4 billion, which is an increase, guys, of around 9%. Now, obviously, this is looking pretty good, except for 3 years ago where they did have a little bit of an off year, but aside from that, everything is looking pretty good. And honestly, I think that my projections might be correct if this continues. Next, we got the free cash flow. And 5 years ago, we had $2.5 billion to 1 year ago of $2.5 billion, which is a little bit of an increase of around 2%, with an average 5-year free cash flow of around $2.15 billion. Now, obviously, actually, this is even more surprising here with the free cash flow. 5 years ago, 4 years ago, 3 years ago, and 2 years ago all seem to be on the decline, whereas 1 year ago it was $2.5 billion. They did bring it up a significant amount. Now, can they continue to do this? I don't necessarily know, but I think the fact that these guys are, you're always going to need Huggies, you're always going to need Pampers, right? You're always going to need all of this stuff, Kleenex, that kind of stuff. I don't think that this company will go under. However, competition might be an issue with this company if they are not able to keep this cash flow going up. Next, we got the revenue. 5 years ago of $18.3 billion to 1 year ago of $19 billion. That is an increase of around 4.5%. And the trend line could be a little bit better. It is essentially flat. The only reason why it's slightly going up is because of my projections. Honestly, at this point, I'm even thinking about getting rid of my projections and just putting in just the actual. So that way, at least on these graphs, so that way we know exactly what we're looking at, right? And the projections aren't skewing over the basic trend line. So I might change this in the future, but for now, this is what it is. Next, we got the debt, and obviously we would like for this to be decreasing or be as little as possible. And unfortunately here for Kimberly-Clark, well, they went from 7.6 billion 5 years ago to today of 8.9, well, almost $9 billion in debt, guys. That is an increase of 15%, which is really bad to see. And also the fact that they are very tight when it comes to their free cash flow because of this dividend that they keep paying out. They don't really have, again, just like I said, they don't really have a lot of wiggle room to pay down debt, make acquisitions, do everything they want, especially if they want to keep that 49 consecutive years of paying and increasing their dividend, right? So that's definitely something to think about. Next, we got the shares outstanding. And again, this is something that you want to be decreasing. The more that this decreases, the bigger piece of the pie you will get as the investor. Here, when it comes to Kimberly-Clark, they are decreasing it by a pretty decent amount, coming from 5 years ago of 356 million shares to today of 336.7 million shares, which ends up being around 6% decrease, which is pretty healthy in my opinion. This is probably where the rest of that free cash flow after paying that dividend is going into, which is buying back shares, which probably explains why their debt keeps going up. And lastly, we got the cash and equivalents, and this is actually very surprising to see. Their cash and equivalents is decreasing by a significant amount, guys, but they currently have around $286 million in cash and equivalents, with an average cash and equivalents of around $518 million. Now, with all of that said, I am going to make a low, medium, and high assumption for this company, keeping the required rate of return around 10% and only changing the growth that I think they might have in the next 4 to 5 years. So for the low assumption, I'm going to say a growth around 2%, which ends up being a target share price not adjusting for debt of $91.05. For the median assumption, I'm going to assume a growth of 5%, which ends up being at around $101.11. And for the high assumption, I'm going to say a growth of 8%, which ends up being around a target share price of $112.02. Now guys, obviously, they do have a lot of debt, right? Their debt has been increasing rapidly, and they have significantly more debt than cash on hand. This means that the target share price adjusting for debt will go down, meaning that for the low assumption, now the target share price adjusting for debt would be around $65.26. For the median, it'll be $75.32 and $86.23 for the high assumption. Now we want to add a margin of safety just in case we would like to make sure that if anything bad were to happen, a recession hits, we have that wiggle room, right? We have that wiggle room that we're not overpaying for something and have that thing go down if something bad were to happen. So with a margin of safety of 5, 10, and 15%, for the low assumption, we would like to buy this company at $55.47 all the way up to $61, essentially $62. For the median assumption, it'll be anything between $64.02 to $71.55, and for the high assumption, $73.30 to $81.92. Guys, the current share price is $142.43. So this is, in nowhere of these assumptions do you even get close to this number. The highest that you'll go to is in the high assumption of 8%, and that's in not adjusting for debt is you get the highest of 112%. Let's actually change this to see what percentage of growth it has to go to. This company would have to go in the next 4 to 5 years for this $142 to be justifiable. Coming over here, let's just put 10%. We're up to $120, right? Let's just not even take the adjusted for debt metric. 10%, $120. Let's say 15. $141.05. So you would have to assume that this company grows 15% year over year over the next 4 to 5 years to make this $142.43 justifiable, which to me, it really does seem out there, especially with the amount of competition that these guys have. I mean, they have Procter & Gamble. I'm pretty sure they have other companies that pretty much make the same products, right? It's not that hard to make Pampers, right? It always is never that hard to make Pampers or Kleenex or something like that, right? So they do have a lot of competition, and this to me seems a little bit, it just doesn't seem reasonable to me, right? But then again, that's my opinion. If you do not agree with it, maybe you agree with that 15% is actually the lowest assumption, right? Maybe you think that this company may grow higher. If you have different opinions than me when it comes to the growth assumption, I highly suggest you go into my discounted free cash flow calculator video, and the link to this calculator is in the description. You log in and you go up here to file, and then you just make a copy and then you can have it for yourself. All I'm asking for, guys, is please subscribe, please comment, and please leave me a like. I really want to grow my channel. I'm giving out this calculator for free. All I'm asking is just help me support my channel so that way I can make more content, right? All in all, I like the company. It's just, to me, the numbers do not justify this share price. But that pretty much does it for this episode. Like, if you like, comment, subscribe. It really does help it with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will get exclusives as well. And only on Rumble, I have a gaming channel called Fatal Play. So if you're interested in something, if you're interested in seeing something that's not investing related, make sure to go there. All right, so with that said, peace out, and be on the lookout for the next stock analysis video.